All right, well, let's start by talking about some of the questions at the end of chapter 4, that is with job order costing, just so that you clearly understand some of the concepts that are being discussed in the chapter. First and foremost, the job order costing involves a unique product, and that is what I'm producing can be easily distinguished from the other products that I'm producing. Now, that doesn't mean that you can't use job order costing if you're producing a batch of goods. So this batch number 1 can be clearly distinguished from batch number 2. The other extreme that we're going to look at, the next chapter looks at process costing. And process costing, the nature of that is that I cannot distinguish one unit of output from another. So for example, if my company is refining crude oil into gasoline, my output of gasoline, 1 gallon, 1 barrel of gasoline, is the same as another. So job order costing is unique to sometimes what are called discrete units, units that can be easily separated. Excuse me. In kind of the extreme case, if I'm producing an airplane, then I can distinguish one airplane from another because it has an identification number. So that would be, again, kind of looking at number 2, the important elements that are involved with the distinction between what is job order costing versus what is process costing. Now, in this chapter, we're going to introduce a couple of concepts. One concept is going to be that there's going to be a lot of documentation. Now, I know that I'm not exactly not the best organized person in the world, but in a business, there must be a process of documentation. There must be an audit trail from the time I set out a purchase order, a requisition form, a receiving report, whatever the case may be, that I can trace back the cost. I can trace back the original purchase. I can show that this was authorized. I can show that it was properly entered into the accounting system. So the job order costing is kind of our first place where we're going to begin to look at this from a point of view of debits and credits. That the job itself is the asset. Remember that in a manufacturing company, there are 3 levels of inventory: raw materials, work in process, finished goods. And the job itself is a form of work in process. You can have any number of jobs going on simultaneously, and so if the job itself is an asset, a type of inventory account, then a debit entry will increase it. That is, as I add materials, labor, and overhead to finish it. And then when I'm finished with the job, I'm going to have to make a credit entry to close it out and a debit to finish goods. And again, this idea of documentation for materials, for labor, for overhead, to show this good audit trail. Now, the issue that we're going to be looking at simultaneously with this is what do we do about overhead? Overhead is a little bit problematic in the sense that I really don't know what my total overhead is going to be until the end of the year. And however, along the way, I may want to bid on a job. I may need to know what the cost is if prices are beginning to change. So one of the things that companies will do is to determine what's called a predetermined overhead rate, where they take the budgeted overhead and divide it by a budgeted activity, such as machine hours, labor hours, and then they apply overhead to the job depending on how many machine hours or labor hours that particular job consumes. The numerator will be the budgeted overhead. Another reason that that's effective is that if I'm using the actual overhead, some overhead costs tend to kind of go up and down throughout the year, such as snow removal. Well, I'm going to incur a lot of snow removal in January, but not much in July. So I may get kind of wild fluctuations. So by using an annual budget, I can kind of smooth out these rates, smooth out these costs, so that I don't have wild fluctuations in my cost. And the more practical reason is that it allows me to estimate the cost, particularly if I'm budgeting, if I'm preparing a bid on a particular job. All right, I think most of these are fairly straightforward here. We'll look at this issue here of number 13 and a problem that we'll look at here, number 30. And that is inevitably at the end of the year, there will be a difference between what I apply as overhead versus what I actually incur. In fact, you'll see that we actually set up two separate overhead accounts. One overhead account will be what I actually incur, and I'm going to keep a running tab on that. The applied overhead is what I apply. And again, every time a job is complete, I debit work in process, I credit applied overhead. So at the end of the year, I'm going to have to reconcile the two. Inevitably, they're not going to be equal, and so I'm going to have to make a small adjustment. Hopefully it's small, it's immaterial. I can adjust it to cost of goods sold. If it's deemed to be material, I'm going to have to prorate it between work in process, finished goods, and cost of goods sold. All right, well, let's look at number 23 here. Number 23 is looking at this from the point of view of creating a predetermined overhead rate, then deciding, okay, did I over-apply, that is, I put too much overhead into work in process, or did I under-apply, that is, I didn't put enough? Well, the predetermined overhead rate is something that you're going to create at the beginning of the year. And you go with the budgeted manufacturing overhead. Hopefully you're accurate with that. And likewise, too, you have to have a driver. That is, how am I going to apply overhead? In this case, excuse me, the company says that they're going to use budgeted direct labor hours. Again, these are things that are budgeted. These are things that we are anticipating are going to happen. So my predetermined overhead rate is going to be based on my budgeted overhead and my budgeted direct labor. So I take the predetermined overhead rate in this case is at $22 per direct labor hour. So for example, if a job requires 10 direct labor hours, I would apply $220 of overhead to it, okay? And once I come up with this rate, I stick with it throughout the year. I don't deviate from that. If the actual overhead is going to be different, fine, I will reconcile that at the end of the year. So number one, the predetermined overhead rate, the normal rate, it goes by different names, is based on the budgeted overhead and the budgeted activity. So in this case, we're talking about $22 per direct labor hour. Now, in this particular case, they say, for example, that there were in fact 212,000 direct labor hours. All right, fine. We go with the actual amount. So we take the 212,000 times the predetermined overhead rate. And remember that that would be debited to work in process. Every time a job is finished, as I've added all materials, I've added all my labor, then I apply the overhead. And in this case, they're saying if I add all those up, it comes out to be 212,000. Yes, it's more than what we anticipated. Sometimes that happens, okay? And the credit entry is going to be to this manufacturing overhead applied or allocated. All right. Now, in this particular case, too, if you look at it with number 3, it says, oh, by the way, the actual overhead was $4,650,000. In this case, the applied or the allocated overhead was $4,664,000, which means that they over-applied here. Actually, it's 14,000, not 74,000. Okay, not a huge amount. Okay, not something to be particularly worried about. You know, when you're talking about $4.5 million, a $14,000 difference is rather immaterial. And in reality, they were pretty darn close with us. So it's not something they're going to have to worry about, not something they're going to have to go back and correct. But I need to adjust for that, okay? I want to make everything equal the actual overhead. GAAP says my cost of goods, both in inventory and cost of goods sold, must reflect the actual cost. So from a point of view of a T account, what I always want to do is to adjust the allocated or applied overhead so that it equals the actual. So I'm never going to adjust the actual. I will either debit or credit to increase or decrease the allocated overhead so that it equals that, okay? In this case, they over-applied, so that means we're going to have to make an adjustment here to reduce, okay? I need to, remember I was making a series of debit entries to that. So I'm going to have to make a credit entry. Okay, now remember that my allocated overhead is sitting there with a credit balance of $4,664,000. I want to actually reduce that down to the $4,650,000. So that means I need to make a debit entry to that, if you want to think of it that way, and a credit entry to cost of goods sold. That by over applying, it also means that my cost of goods sold is over applied. It's too high. I need to reduce it. Now, what they've done here with this particular entry is kind of skip a couple of steps, and they're trying to be kind of efficient. My suggestion is always to take it in 2 steps until you understand what you're doing. Number 1, adjust the allocated overhead. Make it equal to the balance that's in the actual overhead. And in this case, as I said, the allocated overhead is sitting there with a credit balance of $4,664,000. I want that to be equal to $4,650,000. So that means I need to make a debit entry to my allocated overhead. Likewise, too, I can then make a credit entry to cost of goods sold. That makes the adjustment, okay? Then I can close out the 2 overhead accounts, okay? And at that point, okay, I close them out, they're zeroed out, and I've adjusted for that slight over application by reducing my cost of goods sold. So my suggestion is, number 1, adjust the overhead allocated so that it equals the actual overhead. Then whatever I need is either a debit or credit entry to adjust that, and the opposite, debit or credit, will go to cost of goods sold. Then I've adjusted my cost of goods sold. Then I can close out the 2 overhead accounts. Again, they're income statement accounts. They have to be closed out at the end of the year. And I think doing it in 2 steps like that is a little bit easier than trying to do it in one sort of compound entry. All right, this problem is one that kind of takes you through the basics of making the journal entries, creating the T accounts, etc., using job order costing. Now, the first 3 things that they give you here represent the beginning balance in each account. Okay. Then it says that they go out and they purchased 154. We'll leave off all the zeros here. That they consumed or used materials were taken out, placed into production. Likewise, what they say, the ones that I've circled here, are the indirect materials, or the indirect cost, the actual indirect cost of 19 for materials, 34 for labor, 28 for depreciation, and 13 for other miscellaneous overhead cost. Likewise, too, the 96 represents my actual direct labor. They allocated, they incurred 3 million of actual machine hours, and from the information up here, that overhead is allocated on the basis of machine hours. So I'm going to, in this case, allocate, the 3 million times 31, or $93 million. The last 3 things here will help you build the income statement. Okay, so what they're asking you to do is just go through and do the journal entries. Okay, well, number 1, this represents what they bought. Okay, they went out debit, materials control, credit, accounts payable. Likewise, 2, what was taken out, okay, and placed into production. So I'm going to debit work in process and credit materials control. Likewise, 2, whenever indirect materials are taken out, they do not go into work in process. Rather, these are my actual indirect cost. So I'm going to make the debit to my actual overhead account, or manufacturing overhead control, and then make the corresponding credit to materials control. Direct labor is not an expense. It's an asset, part of the building the asset, part of the cost of the creating the inventory. Now, these 3 entries right here, the 34, 28, 13, constitute additional manufacturing overhead amounts. Okay, so one would be indirect labor, Depreciation is not an expense in a factory. It becomes part of the overhead. And then likewise, too, these are other miscellaneous accounts. The 93 million represents, again, the 3 million direct labor hours, or excuse me, machine hours, times the $31, or 93 million. Again, we're leaving off all the zeros. We don't need that. That just adds confusion. Okay. The 298, that was given to you. Okay, that's the cost of goods manufactured. Again, by definition, cost of goods manufactured is what flows out of work in process to finished goods. That was a given. They gave you cost of goods sold, 294. Likewise, you have the revenues, and the assumption is the debit would be to some sort of receivable account. So those are all of the debit and credit entries. To a certain extent, that's kind of the nuts and bolts, the bread and butter of this chapter, is to be able to look at these things and come up with the journal entries. Now, what they've done down here, and I'm not going to go through all the T accounts, you can kind of double check the numbers here with the T accounts that they're creating here. But part of it, again, is the process. Now, in this case, the allocated overhead was 93. And if you go back up here, if I add the 34, 28, 13, and 19, okay, I come up with an actual overhead of 94. So they slightly underapplied. Okay, so if you want to think of it this way, you would remember the overhead allocated is sitting there with a credit balance of 93. I want it to equal 94, so I have to add 1, make a credit entry to 1, a debit entry to cost of goods sold. I've adjusted it. Now I can close out my two overhead accounts. All right. Now, problem number 30 is looking at what do we do with this over or under allocated overhead? And there are several different ways that you can handle that. Well, one, the first thing I need to do is come up with my predetermined overhead rate, which is basically taking my labor cost and dividing it by, in this case, they want to divide it by, my manufacturing overhead is estimated to be 125,000, and I'm going to apply it on the basis of direct labor cost. So I come up with a rate of 50% or 50 cents. Now, what that means is that labor is often a confusing way for people to allocate overhead, which means that for every dollar of direct labor that I incur with a job, I will apply 50 cents of overhead. Or if I take my total labor for a job, let's say it's $1,000, then by definition, my overhead would be 50% of that, or $500. Sometimes the rate could be expressed as 1.5, which means that for every dollar of labor, I would apply $1.50 of overhead. Or if I had $100 of labor in a job, then my overhead would be $150. So it's a little confusing for people. Usually people are okay with hours. That makes a little bit more sense. But oftentimes a rate can either be expressed as a dollar amount per direct labor dollar or as a percentage. Now, in the first case, the labor or the manufacturing overhead rate, the predetermined rate, is 50%, or you could express it as 50 cents of overhead will be applied for every dollar of labor that you incur. Now, the actual overhead, which is number 2, is simply taking that rate, okay, assuming that doesn't change. There's absolutely no reason to change that. I take that times the actual labor cost that I incurred. Yeah, it could be more, it could be less. That's fine. We just kind of go with what we have here. And in this case, the applied overhead was 114,000. That's what they would apply. I go with my actual labor, and then I take that times the 50%. So I would have debited all my jobs for $114,000 of manufacturing overhead. Well, in this case, they tell me, that the actual overhead was 117,000, and as we just calculated the applied overhead. In this case, you kind of look at it, it should have been 117,000. We came in at 114. We underapplied, okay, or underallocated. It should have been that amount, okay. Again, I'm going to draw this arrow. you have to always adjust to the actual. I compare my applied or allocated to the actual. The actual was 117. That's what it has to be. Okay, I came in at 114. Okay, a little bit off. Now, I have the $3,000 difference I need to deal with. How do I do it? Well, one way I can do it is by simply, in this case, they're not asking you to do all of the journal entries. They're just saying, okay, what would I do with it? Well, if I deem it to be immaterial, and you, in terms of quizzes and exams, you'll be told, well, this is immaterial, you may close it out, okay? If they say it's immaterial, it means, in other words, close it out to cost of goods sold. Well, what it means is that my cost of goods sold is understated. If I underapply overhead, it also means that my cost of goods sold is understated, okay? So I need to add the 3,000 to it. So I'm going to change my overhead from 549 to 552 if I deem it to be immaterial. And generally, the basic rule is I always want to prorate overhead, but if something is immaterial, I can get away with doing something a little bit different. Now, another way, the more common way of doing it, when you have to allocate, and first of all, you're absolutely never wrong to allocate it based on the ending balances here. Throwing it all into cost of goods sold is only, I repeat, only justifiable if the amount of difference is deemed to be immaterial. Okay, but even if it's immaterial, I'm absolutely never wrong to allocate it. Okay, now in this case, because they underallocated, what I want to do is to add that 3,000 to these three accounts to bump them up to a more correct amount. And the way I would do that is by taking their ending balances here, which equal 845,000, and then figure out, okay, well, of that amount, what percent is work in process? What percent is finished goods? What percent is cost of goods sold? And generally speaking, cost of goods sold will be a huge percentage of it. Then take those percentages, the 6, the 29, and 65%, and multiply them times the 3,000. So I would add 180 to the work in process, the 870 to finished goods, and the 1950 to the cost of goods sold. Again, it's just simply taking the ending balances here, and instead of making one adjustment only to cost of goods sold, I'm going to adjust the $3,000 to the three inventory accounts, because technically that overhead should have been properly allocated. There should still be some in work in process, there should be some in finished goods, and a big chunk of it should be in cost of goods sold. Now, another way that you can potentially do it is to go by the amount of overhead that is in each account, rather than prorating, the under over application overhead based not only on overhead but also direct materials and direct labor, which is what I did in the second step here. Well, why not just take it on the basis of the amount of overhead that actually applied? And so if I have that information, in which case, this case they gave it to you, the 10,260, 29,640, and 74,100, the 114,000, okay, I use these to calculate my percentage. So work in process contains about 9% of total overhead, finished goods about 26%, and cost of goods sold about 65%. So take these percentages here and multiply them times the 3,000, and I allocate the amount of overhead to it. Okay. Is it more accurate? Yeah, theoretically, because it's based on the amount of overhead, that you're not allowing labor and materials to kind of skew it. Most companies, however, will use the second method, and that is just simply based on ending balances. From an audit point of view, as long as you're consistent year after year, it's not a problem. You have the choice.